Good morning and welcome to NYSE TV Live. I'm Allison Cossack. Today is Tuesday, August 6th, and we're coming to you from high above the trading floor here at the New York Stock Exchange. And we've got a busy morning on tap, from making sense of the recent Wall Street volatility that we've seen to diving into a music sector that's making plenty of noise. But before we do that, let's introduce you to today's bell ringer. The Greenwood Project is on a mission to change the face of finance. The Chicago-based nonprofit organization aims to create career pathways in the financial services industry for Black and Latinx students. Greenwood Project serves current college juniors, sophomores, and freshmen looking to jumpstart their career by learning financial services concepts and industry knowledge. Additionally, the organization partners with companies to find equitable and inclusive solutions for recruitment, retention, and advancement. Greenwood Project offers students an 18-month program with personalized coaching from industry veterans. Here are some figures you should know about the organization. Take a look. Greenwood Project says it's served over 600 students since its inception in 2016. 55% of its scholars are first-generation college students. 70% of Greenwood Project alumni, they now work in the financial services industry. Financial education is the cornerstone of the NYSE and our parent company ICE's charitable efforts. It's not just closely aligned to the business, but also the NYSE and ICE's vested interest in creating a more inclusive financial system, educating the next generation of investors and entrepreneurs, and empowering people to take control of their financial well-being. Our initiative, one initiative in particular, the NYSE Future Investors Program, focuses on including financial education basics for grade school students, advanced instruction on investing and markets for high school students, and data science knowledge and skills for high school students. Staying on the topic of finance, our Judy Shaw recently spoke with Harold Butler, the head of Citi's Diverse Financial Institutions Group, about why Citi's new group was created. Listen to this.
The Diverse Financial Institutions Group was created as part of our overall commitment to help reduce the racial wealth gap. So after George Floyd, the murder of George Floyd, and when many firms made commitments to the street to do their part, Citi made ours, and it was important. It remains important today, but what was key about our commitment is that we knew it didn't just stop at a set of aspirational goals. It needed to go further. And so DFIG is what we refer to it as affectionately, was created to be the execution arm, if you will, of a set of goals that help Citi fulfill its commitment to the street, right? And to engage and lead the way with other financial institutions, to be a catalyst for customers and how they would engage the space, but moreover, to be able to support minority, diverse, broker-dealers, and banks. So that's sort of how we touch and fulfill some of our commitments, is through financial institutions. That's what my group does.
Mm-hmm. All right, so tell me, Harold, why is it important for firms like Citi to support MDIs?
Yeah, it's a great question. And I think fundamentally, at the heart of it, it's all about data, right? So if you just take a step back and you think about the data element of it, right? It's good to have a great strategy that does good and feels good, but we'll take Black communities, for example, using them as an example. There's still 47% of Black households that remain underbanked or non-banked, right? So if you just think about the sheer economic power of that on the number side, and you think about the best way to address that, large banks like Citi and regional banks should all be looking at it from multiple lenses and then using MDIs as a catalyst to drive change, right? And at the same time, be able to do things to drive value, right, to their shareholders, and things that can drive and put the value right back into the communities through the financial institutions themselves, right? So that's kind of the way we look at it a little bit, is to use the banks, the MDI community, to help empower and enrich their ability to drive solutions to the communities they serve.
Mm-hmm. So earlier you mentioned George Floyd.
Yes.
Tell me, what's your assessment of the changes made on Wall Street in terms of a commitment to diversity over the last several years, particularly since the death of George Floyd?
Yes, it's a great question, right? And I think many are asking that question. I would tell you this. I think when it comes to minority deposit institutions, they are in the best position that they've been in decades, right? I think it's a positive story, Judy, as to where we sort of began and where we are now. Sure, there's always going to be more work that needs to be done, right? That the work, I think, is ongoing, right? Maybe there are new challenges and new opportunities, but I think much has been done to change the narrative. Before George Floyd, there were roughly 19 Black financial institutions. Today there are 21. So we're starting to see growth in the space, but more importantly, the banks themselves have become incredibly well capitalized, the majority of them, right? So from banks like Citi and other financial institutions, corporates have all sort of been doing their part to put capital on these balance sheets, to include the government. The government did a great job with ESIP funding, over $9 billion they put into the space. Some of these banks double in size like almost overnight. That's a great narrative, right? Now the challenge, right, and the opportunity at the same time is really how to unlock that capital, right? So things like deposits remain very key and critical to the banks. For every $1, the banks can raise $10 and they put that capital to work, right? So that's the next sort of quandary, is to figure out how do we help empower the financial institutions to deploy capital, right? To make good use of how they do capital, how to manage that process, but more importantly, how to get those deposits, right? We're very focused as Citi on, again, doing our part to help unlock the liquidity aspect of it, and to continue to have the dialogue. Like, our dialogue is very important to the overall story.
Elsewhere on Wall Street, investors are looking for answers as volatility rocks the market. I want to briefly take you through what's kind of happened over the past week. On July 31st, the Fed announced it was keeping rates unchanged at 5.25% to 5.5%. That's hardly a surprise. The central bank, it hasn't moved rates since last July, and borrowing costs remain at their highest level in 23 years. However, the Fed also signaled that rates could be coming down soon. So when asked about the possibility of a rate cut in September, Fed Chair Jerome Powell said the following to reporters, and I quote this. He said, "The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market." He went on to say that if that test is met, a reduction in our policy rate could be on the table for as soon as the next meeting in September. Okay, so far so good. After he said that, the major averages ended that day, Wednesday session higher, and according to market experts that we've had on here at NYSE TV Live, investors, they were not only hoping for but fully expecting a September rate cut. Okay, so we move on to Thursday. We started to see optimism begin to fade on economic fears. The Dow fell by almost 500 points. This happening on August 1st after the ISM Manufacturing Index, which is a gauge of factory activity in the U.S., that index slipped to an 8-month low in July. The data revealed that the manufacturing sector contracted for the 4th straight month and the 20th time in the past 21 months. So that has begun to stoke fears of a potential recession. Then we move on to Friday morning. Those fears were amplified by the results of the July jobs report. According to the Bureau of Labor Statistics, the U.S. economy grew by 114,000 jobs. That fell well short of the 185,000 that was forecasted by economists surveyed by Dow Jones. Additionally, the unemployment rate, we saw that shoot up to 4.3% in July. That was the highest since October of 2021. So the major averages plummeted, with the Dow shedding more than 600 points during Friday's session. And we saw the weekend doing little to cool off all that uncertainty and anxiety for investors, because on Monday, the sell-off continued here on Wall Street, with the Dow dropping by more than 1,000 points on Monday during the session and suffering its worst day since September 2022. Let's talk more about this. Joining me now to tell us what to make of all this volatility is Patrick Young. He's the chairman of Exchange Invest. So glad to have you on the show.
Thank you. Joy to be here, Alison.
So this isn't the first time investors have received surprising economic news. What's the driver, or what are the drivers that we're seeing for yesterday's significant sell-off?
Look, it's a cornucopia of factors, actually, Alison. You mentioned very, very well what's going on in relation to the Federal Reserve, etc. In the big wider world, take that great New Yorker's cartoon of Manhattan. Those things that are happening way beyond the purview of the New York Stock Exchange have had cause to cause us some concern. And therefore, we've got an upheaval in Bangladesh, Sheikh Hasina. There are all sorts of other issues in the Middle East. And most importantly, I suppose, the thing that we haven't touched upon so far is the end of the Japanese yen carry trade. Because while the Fed weren't cutting interest rates last week, Japan finally moved into positive interest rate territory. For the first time, essentially in a generation, we actually have the possibility to earn some money, an infinitesimal few basis points on our Japanese yen. What did that do? Well, a lot of people, they've been borrowing very cheap money in Japan and lending it to the rest of the world, or using it to buy assets. And a huge amount of the shock that we saw that came into the market, especially in Japan yesterday, but also to that same degree in New York over the course of the last couple of days, was driven by a lot of sudden fear that an incredible epoch is over. The era of free money in Japan is coming to an end. And at the same point in time, the Fed seems to be strangling the market with what the current generation of traders think are unseemly high interest rates. But unfortunately for grizzled old traders like me, they seem like a drop of the ocean and rather normal.
All right, so let's talk about the Fed then. It signaled that it could start cutting rates in September. The economic data that we've seen definitely favors the move. Do you think, first of all, that the Fed has held rates where they are for too long?
I think the Fed has found itself in an invidious position, so therefore it has probably held rates for rather too long at this sort of level. But of course the difficulty is that the Fed is under fire because it held rates far too low for far too long, and that's why the ghost of inflation is back upon us. How ironic, 45 years ago today, Paul Volcker entered the Federal Reserve Bank and he started killing inflation. It was a dragon that took 20 years to slay, and yet under the current Fed management they let it all out of the bag again within the course of a year or so over COVID. So therefore, the Fed's traumatized. That's why they're slow to cut rates this time round. That's why they should have been cutting rates slightly earlier to preempt what was going on. And of course, in the background, you've always got this political phenomenon, haven't we? The Federal Reserve, entirely independent. But as we know, there's an election looming in the United States of America, and therefore you have to be very, very careful that all the data lines up in favor of a rate move in order that you're not seen to be playing politics.
Wow, a traumatized Fed. I never pictured it like that. So if you were able to sit and talk with Fed Chair Jay Powell, we're seeing the CME Fed Watch tool is pricing in more than a 70% chance of a 50 basis point cut in September. Do you think that's an overreaction? Do you think that's an underreaction? What would you tell the Fed to do?
I've got to say right now, if you come in and do 50 basis points in September, that could actually unnerve the market to some degree. We've really got to see what that data is. I do think, to be fair to the Fed, even though they have made mistakes in the past by letting the inflation genie out of the pack, they need to think coherently about what they're doing. I think it's more likely we're probably going to see a series of small cuts. They'll probably take 25 basis points. Maybe they'll go the whole hog with 50 basis points, who knows? But certainly I think we've got to allow for the fact that they're going to have to cut rates during the course of September, simply to show the fact that they are caring. I think also there's a data issue here. A lot of the high-level data that's being absorbed by the world's central banks, the Federal Reserve in the US, the Bank of England in the UK, doesn't necessarily hit the bottom end of Main Street, and therefore when suddenly we have this incredible epoch of data change. I mean, I was on the floor of the New York Stock Exchange essentially a month ago when we saw that unemployment number. It looked fantastic last month. This month it looked appalling. Why? Not just because of the headline rate, because there was a huge ripple of different revisions that were going through the whole field. So the whole, if you like, yield curve of unemployment suddenly looked very, very different going back several months.
Okay, let's talk crypto, because all this volatility also impacting crypto. The price of Bitcoin was above 68,000 a token. I just looked at it, it's below 55,000. Wow, just over a week later. Ether sold off even more significantly. Do you think there are additional or different fears that crypto investors have at this point?
I think the issue here is actually one that there is a fallacious notion, Alison, which is the idea that crypto is somehow or other an asset class on its own. It's actually traded, and its history is an incredibly speculative asset class which loves the idea of cheap money, which therefore people are going to throw in. Because let's face it, when you buy Bitcoin, unlike buying the stocks on the New York Stock Exchange, you're not going to get a dividend. You're just looking at capital appreciation. And that's why throughout the course of history, a lot of the Bitcoin acolytes have tried to say, oh, it's the new era of money, whereas actually, realistically, what we've ended up with, and don't forget I've been a crypto advocate for over 25 years, is something that ultimately is just a speculative asset, and rather like gold, but without the industrial application, Bitcoin, all of these other cryptocurrencies, they're essentially just pixels that people are speculating on. And that's a very, very different thing entirely. And that's why, as soon as the stock market goes down, people are looking around, they're going, oh my goodness, I better pull some capital back so that I don't lose too much money. And they're selling out of things like Bitcoin very, very rapidly. So therefore, I would say overall, we're going to see a similar equivalent tracking of the cryptocurrencies against the health of the stock market and the risk on assets.
All right, Patrick Young, thanks so much for all of your great analysis.
You're welcome.
All right, let's switch gears for a moment. A recent survey conducted by the Oliver Wyman Forum revealed that 93% of chief executives of NYSE-listed companies viewed cybersecurity as a risk, not an opportunity. Our Trinity Chavez recently spoke with Kim Rivera, the chief legal officer at software company OneTrust, about some of the challenges she's facing. Check it out.
So at OneTrust, we're focused on making sure that companies can have confidence that they're managing their most valuable asset, their data estate, in a way that enables them to innovate and focus on business results, and to do it in a way that's safe, effective, and transparent.
Can you give me a real-life example?
We have a partnership, for example, with Adobe. When you think about marketers and how they want to gather and use consumer data, in order to serve the consumer well, they also need to be able to demonstrate that they're doing it responsibly.
You mentioned how we're in a rapidly changing ecosystem right now. How does OneTrust navigate through this landscape? How does it stay ahead of the curve and yet remain innovative while meeting customer needs and demands?
So the first thing is just to be in tune and in touch with what is happening with our customers and what challenges are they trying to solve. Today, everyone is racing to figure out, they're under tremendous pressure to figure out, how can I deploy AI? How can I deploy it in my company? How can I protect against the risks of third parties deploying it in my vendor chain? And at OneTrust, we're making sure on the front end that we really understand what customers need, and we're simplifying and embedding all of those regulations, all of the requirements, the data governance, the controls into our platform in a way that allows our customers to simply deploy the solution.
Tell me where you see the cybersecurity sector going in the next 3 to 5 years.
The application of AI has opened up a whole new risk vector that companies have to deal with. You're seeing things like DORA, the Digital Operations Resiliency Act in Europe. And the reason I use that example is because the amount of complexity and burden on companies to really be able to demonstrate that they have secure, effective systems in place is going up. And what that means is they increasingly can't afford to have siloed systems, siloed data management, and a lack of context and visibility across the entire data estate. And at OneTrust, what we're doing is trying to give them a one-stop shop where they can do that across their data estate and start breaking down those silos and have an efficient way to manage the data estate.
Well, thank you so much for joining me today.
My pleasure.
In addition to economic headlines, earnings season is also impacting the market. One area making a lot of noise is the music industry. Joining me now is David Schulhoff. He's the founder and CEO of MUSQ. So great to have you on the show.
Thanks for having me.
Let's talk about your firm and the MUSQF ETF. It aims to invest in the most attractive segments of the global music industry. Walk me through what it is and what you're seeing.
Yeah, so we're the first pure play music ETF designed to capture all the growth and innovation in the global music industry across streaming, content and distribution, live music events and ticketing, equipment and technology, and satellite and radio. MUSQ really gives investors a front row seat to invest in companies like Spotify, Live Nation, Warner Music Group, Universal, and really exciting companies internationally like HIM in Taiwan, Tencent, Cloud Music, CTS, and Ventum. We have 38 companies in our fund today, and it's a really exciting time to invest in music.
Market had a big rout yesterday, but what did you see with your fund?
So not surprisingly, we were very resilient yesterday. Universal was flat. Tencent was slightly down. CTS Eventum was down 1%. Most of the top holdings in our fund were down just like anywhere from flat to 1% or 1.5%, because music is really not correlated to the rest of the stock market. Music is its very own unique, segment of the industry today. So we have all these companies in our fund, and we believe that music represents the most attractive segment of the entertainment industry. Music is undervalued. Music is underhyped. Music is undermonetized. If you listen to JP Morgan today, music is the best content story in the history of the media business. Music is cheap compared to what you pay for Hulu, HBO Go, Disney, so we believe that music represents a very compelling investment opportunity today.
What do you think are some of the biggest takeaways that we should have based on of what music companies are reporting in their quarterly figures?
Look, I think the big takeaways are that streaming is really driving a lot of this growth. If you look at Spotify, the company's been on a tear. It's up 80% for the year. It's up 150% for 1 year. 87% of all music consumption today in this country is dominated by streaming. Revenues are up 20%. And if you read the Goldman Sachs report, Music in the Air, the industry is doubling to 180 billion by 2030. There's 700 million paid streaming subscribers today. That number is going to 1.2 billion. Spotify just crushed it. They were up 12% paid streaming subscribers to 246 million. And so we're entering into a golden age with music. It's about the digitization of music. It's about streaming. And all the content companies are tied to all the streaming companies, not just Spotify, but Tencent, Apple, Amazon, Google. 70% of all these revenues for all these streaming services get paid to all the content companies. So if you look, it's not a surprise that, Universal reports revenues up 8%. All the companies are reporting anywhere from 8 to 20% revenue growth on the content side, because it's all attributable to streaming.
Now, we are seeing the price of some music streaming platforms, get hit by inflation. So based off what you're seeing, is the demand there to warrant it, or could price hikes wind up backfiring on these music companies, do you think?
There's absolutely no indication that the music industry would have any attrition to inflation. If you look at COVID, right? People were subscribing to 1 to 2 times their services. So there's no, music is cheap. Music at $10, music is undermonetized. Spotify raised rates twice in the last 2 quarters, and they crushed earnings both times. At $12 a month for 200 million songs, that is really cheap. You pay double that for Netflix, you pay double that for Disney, and you have to subscribe to several of those services to get all that content. So for 200 million songs, $12 a month, that's a really good bargain. So there's no indication that even with inflation that people are going to cut off their subscription services for music. Music is really, really cheap. I think Spotify should charge, 2 times more than what they're paying right now, but that's just me.
As we're talking, we are seeing today's bell ringer, Kwesi Smith, the CEO of Greenwood Project, walking to sign the distinguished guest book. We'll continue our conversation here as well. Taylor Swift's Eras Tour, it has been the biggest story in music since it kicked off in March 2023. But the tour takes a 2-month gap starting later this month, ultimately ending in December. How significant do you think the absence of the tour will be for the industry at large?
Look, Taylor is not the entire music industry. Even according to the Luminate report, she was, 5% of the 4 trillion streams in 2023. Look, live music is really happening. It's not just her. It's Morgan Wallen. It's Beyonce. It's all the amazing country acts. Look, Live Nation is an incredible company. That company reported earnings last week. Revenues were up 8%. Ticketmaster revenues were up 12%. We'll see what happens with the Department of Justice investigation. But look, they doubled their output of shows for 2024. So look, and if you look at companies like Sphere, which is also in our fund, that company's been on a tear. I don't know if you've been out to the venue in Las Vegas. It's incredible between the Eagles and Dead & Co. and U2. What an immersive, great way to see music, to see live music.
I want to get a question on AI. The 3 major recording labels, they've sued AI music platforms. I want you to break down what's happening here, how monumental the outcome here could be.
Look, here's what's happening, okay? AI companies like Suno and Udio, those are the two companies you're referring to. These are AI technologies, and they are training their algorithms to copy Weeknd, Drake, Taylor Swift, and so that's why all the labels are up in arms. Okay, so that's number one. Number two, the second problem is there's no federal copyright protection in your voice, and that needs to change. So if you look, Marsha Blackburn actually just as early as last week introduced a bill before Congress, the No Fakes Act. It was nurture originals, foster artists, keeping entertainment, and there's also an No AI Piracy Act that was introduced in the House. And so these bills need to get passed, they need to get signed, because what's happening is there's a lot of benefit to AI. Producers can create new songs, but the companies are training their algorithms to copy the market of existing product. And so the labels are freaking out because of that.
All right, David Schulhoff, it's so great talking with you about the music industry and your ETF. Pleasure.
Thanks
Thank
so
you.
much.
All right. Greenwood Project is minutes away from ringing the opening bell as it promotes its push to change the face of finance. Judy Shaw recently spoke with BlackRock's Jabari Magnus and Lyanda Delp about community engagement and offered advice to aspiring Black leaders. Take a listen.
Do it the community like within BlackRock, through our Black Professional Network. That has extensions throughout the entire BlackRock platform, which we know is one of the largest in the world. In addition to that, like personally, I take time to spend in my local community as well through an organization known as Project Transition, where we actually tap into the youth to figure out pathways like for them to transition to their dreams.
So now, Lyanda, tell me, how do you celebrate or commemorate Black History Month in your own life?
Do you know what? I probably don't do enough, but I do a lot of small things, especially with my children. I'm always sharing with them the stories. I have teenage and school-age children, and I share it with my community of friends and really try to represent and support our community. Jabari mentioned the really robust network that we have at BlackRock. There's a very informal network as well, an informal community. And so what you find is that people reach out, and I make myself available to engage, to give support, to give mentorship, or just to share a major accomplishment, promotions, new wins in our client businesses. All of those types of things really help to reinforce the community, and I think that's all part of it.
Mm-hmm. Now, Jabari, tell me, what advice would you give to aspiring Black leaders in their professional journeys?
I think that there's a few things that we need to make sure that we key in on, but the number one thing is to strive for excellence, right? To strive for what your expertise is, and to tap into that and be second to none at it, because that not only provides yourself with the accomplishment, but also shows others what can be accomplished.
And Lyanda, how about you? What's your advice?
I think those are great points. I would add, just play the long game. Think about your career as a long period of time. And so persevere, bring out all that resilience that's within us as a people. We've gone through a lot. Don't let, minor setbacks derail you. Just keep focused on delivering excellent work, and it will pay off. There will be opportunities, and people will see you shine. And you will have the pride of having delivered in an incredible way throughout your career.
And back here live on the floor of the New York Stock Exchange, we are about 2 minutes, less than 2 minutes before the opening bell. Greenwood Project is going to be ringing the opening bell. Its CEO, Kwesi Smith. I don't know if you caught him before. He was walking to sign the distinguished guest book. He will be ringing the opening bell. Greenwood Project is a national nonprofit that was founded in 2016 to introduce Black and Latinx high school and college students to careers in financial services and to prepare them to succeed in the industry with skill building and internships. This project, this charity, has served over 600 scholars, expanded to a college and a high school program. It's incorporated a fintech program into the education model. More than 70% of the organization's scholars, they are currently working in financial services. So this is a charity that really helps these folks with their careers and their financial lives. All right, we seconds to go before the opening bell. Just got to tell you, after yesterday's sell-off, we are seeing green arrows across the board. The Dow is up about 60 points. And now 15 seconds before the opening bell, Kwesi Smith, the CEO of Greenwood Project, is going to be ringing the opening bell. Let's take it away. Show you the live look. And joining me now is Michael Rankin, Senior Market Strategist for the NYSE. I'm so glad to have you on the show today after we saw that big sell-off yesterday. We are seeing some green arrows today. What sense are you getting from investors about the pace of the sell-off that we saw yesterday? And what's going to happen from here? Was it a one-off, or is this sort of going to be the short-term trend?
Yeah, so I mean, yesterday's sell-off, I think, was like a confluence of events, right? Which kind of really started last week when we had the BOJ, kind of raise interest rates a little bit earlier than markets had expected, and then we capped off the week with some weaker than expected economic data. We did see some pretty significant weakness coming out of Asia, kind of over the weekend, right? And that really, it seems that we're kind of much of what's happening is kind of an unwind of positioning, right? As opposed to, I think, like a real scare about a recession or anything of that nature, right? So kind of the first point of that is being kind of, and the epicenter of that is coming out of the yen carry trade. So for many years and many decades, right, investors have been able to kind of fund, kind of positions using, kind of the yen as a funding instrument, right, to buy higher yielding assets and things of that nature. And then, kind of as those investors have started to unwind, right, and after many decades, they've kind of went out on the risk curve, right? So not only using that to fund, kind of treasury markets, but they've, kind of expanded to kind of cryptocurrencies and equity markets, right? And so you saw a pretty big unwind of that yesterday. Now, at the open, we saw kind of the VIX hit about 65. We backed off to the low 30s, by the end of the day. For viewers, what that suggests is that we're going to see about a 2% move on any given day, and about a 4 to 5% move on a weekly basis, right? So I would expect to continue to see some volatility here in the near term.
As we're seeing now, the market opened in the green. It's now turned red. I'm talking about the Dow. We can't ignore the data, though. You mentioned that you don't see this necessarily as a recession, but we did see the ISM data show contraction. We did see a disappointment in the jobs report, to mention just two there. I mean, how can we interpret those?
Yes. So, I mean, as I've been sort of talking about, kind of in our daily and weekly notes, we have seen signs that the economy is slowing, right? And so, this was a continuation of that. Last week we saw the initial claims data jump, up to almost 250,000. We had the weak ISM manufacturing, and then Friday's jobs report came in below expectations at about 100,000 jobs, and with the unemployment rate ticking up. Now, within that report, right, there are a couple of things that I'd highlight, right? A, there's some seasonal adjustments that are in question, right? We also have some weather, weather-based adjustments, given the hurricanes last year. And then in terms of the unemployment rate, right, that did move higher, partially due to the fact that we had the labor participation rate moving higher, right? So there are actually some, kind of positive reasons for the, kind of that unemployment rate to tick higher. What that has done is it did trigger kind of this SOM rule, which suggests that we're at the beginning of a recession. But once again, like it's why that unemployment rate is moving higher is pretty important. And what we saw yesterday was markets, and there was some fodder that we would start to see here the Federal Reserve, kind of come in with an emergency rate cut, potentially as early as this week. All right, that made absolutely no sense to me whatsoever. Right. The data that we saw last week does not suggest that we're kind of heading into a recession or at a recession point. Yesterday's ISM services, right, also kind of helped stabilize markets because that came in better than expected, right? So what I think we have done is more squarely put the potential of a 50 basis point rate cut on the table for the September timeframe. But unless things get significantly worse between now and then, right, I'm not expecting to hear anything different from the Fed.
So are you saying investors are pricing in that 50 basis rate cut in September?
Yeah, I mean, so markets have started to price that in, right? We're, it's not quite at 100%. I think at points yesterday we were priced in at 100%. Look, it's going to be dependent on the data as we move forward, right? We're going to see 2 more labor market reports. We're going to get the inflation data, right? And so, the Federal Reserve with the, if you look back at their summary of economic projections, right, that they just gave us, in June, right, they were looking for the unemployment rate to be at 4%. We're already at 4.3%, right? So, right, that gives them, plenty of space to cut by 50 basis points.
Okay, with all the activity going on in the market, we forgot that we're in the midst of earnings season, right?
Yes.
What have investors been taking away from the figures over the past few weeks?
Yeah, so in terms of earnings, right, the bottom line numbers have come in pretty good. What I would kind of highlight, and it's been a big theme that I talked about in our preview, is that we're seeing those bottom line numbers hold up, partially due to the fact that companies have kind of instituted these kind of cost-cutting and efficiency measures over the last few quarters. We are seeing some top-line weakness, right? And so, with that top-line weakness, we're not seeing kind of companies necessarily being rewarded for that bottom-line beat, if they're missing on the revenue side of things.
Michael Rankin, always so great to get your expertise, especially on these volatile market days. Appreciate it.
Thanks for having me.
Okay, see you next time. All right, we're going to be speaking with today's bell ringer, Kwesi Smith, in just a few minutes. But first, our Trinity Chavez was recently in Los Angeles, and she was covering this year's Canva Create event. The design platform aims to revolutionize the way creators create through their innovative tools for creating social media graphics, presentations, promotional merchandise, and websites. Check it out.
Canva Create is back for 2024, and it's bigger and better than ever before. Trusted by more than 90% of the Fortune 500 companies, many of which are NYSE-listed companies, Canva is revolutionizing how creators create. They have taken over SoFi Stadium and the YouTube Theater. Over 3,500 are here today, while millions of people from around the world are tuning in. With over 50 different speakers, 15 sessions and workshops, all led by the Canva team, promising to make this like an unforgettable experience. We're speaking to Canva's leadership, investors, and board members about what's driving the success and how they're simplifying design.
We are extraordinarily excited to bring Canva Create here to Los Angeles. So our mission is to empower the world to design, and we quite literally mean that. We want to empower every single person to design anything that they could possibly need.
It has been so cool to see some of the Canva superfans turn out today, because it is the community that really drives us. Canva's user base has become incredibly diverse over the last 10 years. There's something for everyone, whether you're a teacher, a student, a CMO, a sales executive.
At Canva, our core product philosophy is really about making complex things simple, and we try to embed that throughout the entire product's process.
When I met Mel and Cliff, it was just an incredible meeting, and they described to me their vision for Canva. They wanted to go make design simple for everyone. 10 years later, they're the most used design tool on the planet. They just sat there and built something that the world needed.
I'm a designer at heart, and for me, being able to actually have a place to find my own creative confidence and not have to start from scratch every time is really, really special.
We were very fortunate to invest in the first round of Canva. I think it all started with Melanie and this one idea. She was very passionate, just right from the beginning. Like when we very first saw her pitch, there was something special here.
It's just been amazing to see the company grow and to see them take on giants and win.
Canva's culture isn't just something that you come into, it's something that you actively contribute to. And the other things that are really important to us is making sure that our culture is rooted in our mission, and then that means that everyone collaborates in a really meaningful way towards what we're all trying to do for our community.
We have the most amazing community, and seeing what they use Canva to create has been incredible. You're seeing people get jobs because they've created a resume, or a lady find her birth mother by creating a poster. All of these incredible stories really warm our hearts and keep us motivated to keep going.
And joining me now is today's bell ringer, Kwesi Smith. So glad you can take time out to join us.
Yes, thank you for having us here.
So let's talk more. Why is ringing the opening bell here at the NYSE so significant for your organization and the message it's looking to send today?
Well, we're celebrating 8 years of empowering the future for Black and Latino individuals who want to make a career in financial services. And so it's a momentous occasion for us to come from where we started, which was a pilot of 5 students in 2016, to now a program where we're training roughly 50 scholars every summer to get into high trajectory careers in financial services.
Walk me through why this work that you're doing is so important.
It's so important. So if you think about it, a lot of Black and Latinos are disconnected from the industry, and they don't even consider that this industry is an opportunity for them to have a successful career. I jokingly tell people the only time I saw someone Black growing up on TV was Eddie Murphy in Trading Places, right? And so really what we're doing is we're stepping in, we're finding individuals that are intellectually curious, have the intellectual horsepower, and have the grit to really persist in careers in financial services and get them excited about it. So it's really us connecting these high-quality individuals and scholars to amazing opportunities in the industry.
What do you think are the biggest challenges facing students participating in the Greenwood Project, and how is your organization, uniquely suited to help these students overcome these challenges?
That's a great question. So one of the biggest challenges is what I just alluded to, is really building what we call aspirational capital. That's the desire to want to participate in the industry and really see yourself thriving in the industry. The second is the social capital. So a lot of our scholars, as I indicated, are disconnected from the industry. They don't have someone in their network that can kind of help them transition into the industry. And so by participating in Greenwood Project, on average, our scholars meet about 100 new professionals. That's not each other, right? That's professionals in the industry that help support them transitioning into the industry. And then the third is just the academic capital. It's really closing that opportunity and that gap to get them from where they need to be to where they really need to be to have a successful career in, say, for example, investment banking, right? And so that's where we really step in to kind of help support our scholars through this journey.
What are some goals and initiatives that you're looking to accomplish within the next 6 to 12 months?
Within the next 6 to 12 months, that's a great question. So right now, we're in a major evolution, and we're innovating and strengthening our program. So we're going from training our scholars for 4-week intensive over the summer to an 18-month learning journey. And so that's really going to set our scholars up to come in, develop the personal clarity they need to figure out where they want to go into the industry and then persist into the industry. So that's the biggest change. And then we're also scaling and growing the organization. So this year we trained 50 scholars. Next year we're aiming to do 80. The year after that, 100 to 125. And so we're really excited about both the lengthening and elongation of the learning journey, as well as continuing to scale and grow the organization.
Kwesi Smith, it's been such a pleasure learning about your program, and congratulations on the program and ringing the opening bell and everything that you all have attained.
Okay, thank you.
All right, thank you.
Appreciate it.
All right. Greenwood Project is just the latest organization to ring the bell. In late July, Domino's Pizza, which trades on the NYSE under ticker symbol DPZ, celebrated its 20th anniversary of listing right here at the exchange. Judy Shaw sat down with the CEO to discuss the pizza giant's latest strategies. Check it out.
Russell, it is wonderful to have you on Floor Talk today. Thank you for joining me.
Thanks so much for having me.
So, Russell, recently you announced your Q2 2024 results. Tell me, how has the Hungry for More strategy driven Q2 growth?
So Hungry for More is all about delivering 3 things: more sales, more stores, and more profits. We've been doing pizza for a long time, 64 years. You can see it's our 20th anniversary on the exchange today. And what we've learned is there are 4 ways to drive those 3 things. The first is the M for most delicious food. The O stands for operational excellence. You can only promise delicious food if you can deliver it. The R is something everyone's looking for now, which is renowned value. And the E is everything we do is enhanced by our franchisees. So if you look at our strategic pillars, they drive all of our tactics that have led to that great Q2 we just finished.
So now you have New York style pizza. How has that impacted your menu?
When we do innovation at Domino's, we like to think about it as innovation with intent. Don't just come out with a new product while you come out with the product. And so with New York style, what we're doing is reaching a customer who likes a different style crust, a different cheese blend than our regular pizza. And so you're from New York, right? You know, New York style is a little bit more foldable, a little thinner crust. And so that's what we're targeting, this incremental customer. And so far it's been really successful.
What improvements have led to the 10% better delivery times in Q2?
10%, look, we always consider ourselves We have high standards for ourselves for pizza delivery, and we know we're the best in the business, but we wanted to get better. Because remember, the O in Hungry for More is about operational excellence. And so we've had programs. Last year we called it Summer of Service. This year we're calling them It's More Delicious Operations. And these are programs where we work one-on-one with our franchisees to both help them use our DOM OS, which is our operating system, the computers in the store, make sure that links up with the circle of operations. And how can all of that run a little bit better? We sell 1.5 million pizzas every day in the States. And so you really got to be at your best. So we've improved over the last 2 years 10% on what we already know are the best delivery times in the business.
Now, Russell, talk to me about your revamped loyalty program and how it's boosted orders.
Well, we had a loyalty program we launched in 2015, and it was really successful for us, multiple years of growth, and we expect multiple years out of this one. What we looked for the improvement was what wasn't working in the first loyalty program. First loyalty program was really good against our heavy users, but light users, not so much. We're relatively new in the carryout pizza business. Everyone knows for us for delivery. We also needed to make it better for carryout customers. So originally, the last program, you spend $10 to get points, now $5. Why? Because carryout customers spend less. The old program, you had to buy 6 times to get something free. Now you can buy just with 2 orders, you can get something free. And so our objectives were to move amongst the carryout users against light users to increase their frequency, increase folks coming in, and it's happening in a really profitable way for our franchisees.
All right, and finally, Russell, what's your favorite pizza?
My favorite pizza is this New York style pizza, a pepperoni. Actually, I have 2. I'm sorry, I'm gonna have 2. Pepperoni New York style. My first job at Domino's, I ran marketing and new products poured into me. My wife's a vegetarian and I'm not. And so I asked the team, I said, can you help, put together a vegetarian pizza that I would like to eat so I can eat with my wife? And so we now have it. It's called our Pacific Coast Veggie Pizza. It's been around for about a decade. Have it on a thin crust. I promise you'll like it.
All right. Well, next time, you got to bring some pizza.
I'll bring it here, I promise.
Russell, it's been wonderful to talk with you. Thanks for joining me.
Thanks so much. I appreciate it.
After yesterday's sell-off, I want to take a quick check of the market, seeing the Dow in positive territory, but just sort of barely up 66 points. We will have it, keep an eye on it. Fingers crossed to stay in the green. That's going to do it for today's coverage. I'm Allison Kosick. See you next time.
In life, I'm reminded that it's not about the destination. It is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital markets here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.